afternoon, everybody, and welcome to another edition of ChartWatch Live. My name is Capolingua. I'm from Market Index and Live Markets, and it is a pleasure to be chatting markets with you on a Wednesday. A little bit going on in markets, so I don't want to take too much time in the introduction, but I will tell you that we're going to do the all-important portfolio management. And if you're watching the recording on YouTube and you've gone, oh, wait a second, I'm already bored, I'm about to switch off. This portfolio management model, I think many of our regular listeners will agree, has been one of the single most important revelations for them when it comes to their investing over the last few weeks. That's coming up first, and then we're going to get to your requests, your favourite stocks, and I'll do some technical analysis on those. Plenty of educational content as we go through, and there's been a request for a bit of a review of the lithium price and lithium markets as well. I know we did it last week, but we'll do a very quick catch up this week. That's the Nasdaq Composite, and this is how we determine if you're trading in the US, how full you should fill your risk bucket. And I think that's just a wonderful analogy for how this model works. Is when the market is going gangbusters. For example, we've got strong short-term uptrend. That's the light green ribbon. The dark green ribbon is the long-term trend. So both traders and longer-term investors both want to be invested at that point in time, and by the nature of them wanting to be invested, they don't want to be uninvested. So they've got cash, they're applying it to the market. We call that demand. At the same time, they're holding shares, don't want to apply those to the market. That's supply, and they're withholding supply. So when you've got lots of demand and you've got supply being withheld, you've got excess demand. And the oldest relationship in economics, ladies and gentlemen, is when there's more demand than supply, price is probably going to go up, isn't it? We say more often than not. So when price is more often than not going to go up, it makes sense to fill your risk bucket to the brim. And I've had a few emails about this risk bucket. What does it mean? Well, if you're investing in the US and you've allocated, 20% of your portfolio, your overall capital to that endeavour, then this system manages that part of your overall portfolio. It doesn't talk to what you've got in property, doesn't talk to what you've got in bonds or cash. It just speaks to that part of the portfolio. And we have a different benchmark for each part of our portfolio. What's the benchmark for property? What's the benchmark for cash? What's the benchmark for bonds? I'll let you discover all of those in your own time, but this is the one I use anyway for US stocks. Okay, so we've got some problems. We're not full bucket at this point in time because as that relationship between demand and supply changes, we're going to get signals in the price action. There's no other way it can happen, ladies and gentlemen. This is why I'm so cavalier on the way up. And at the time, I would have written something in my ChartWatch analysis that I do for Market Index every day. I would say, hey, everybody, the trends are very strong. I'm happy to be fully invested this time, all the while knowing that we'll never see when the top occurs. I mean, technical analysis, as many critics will say, it's like driving a car by looking in the rearview mirror, and my style certainly is because it doesn't prognosticate, it only follows the trends. But what I don't want to do is miss out on the wonderful low risk, low volatility environment to make money into that point. And I know that at some point it must be this way. There's no way that markets can crash. There's no way markets can roll over, correct, pull back, whatever you want to call it, crash without seeing black candles first. Okay, there's no way that can happen. It must occur. There's no way that markets can roll over, crash, and all the horrible things can happen without the price action moving from rising peaks and rising troughs on this side to falling peaks and falling troughs on the other side. It must happen. Sometimes it can happen quickly, sometimes it can happen slowly, but ladies and gentlemen, it must happen. And we saw those signs. So I don't worry about too much about markets crashing on the way up. As I get the signals, I start to manage my risk. We have some rules about interactions with the short-term trend ribbon. Typically, I don't like to see a close below it. We didn't get it on that day there. Up we go, and it was on this day here that I pulled back the maximum level of the risk bucket. So my model goes from fully invested, and you don't have to be fully invested, but you're allowed to be, that's the point, to 2/3. And you might say, well, that's a big jump. Why don't you go somewhere between? Look, it's just the way I like to do it. Get the risk off and then ask questions later because something's probably not right. At that stage, we've got lower peaks and lower troughs. We've got a predominance of black candles creeping in. There's some actually decent sized candles in there, so we're seeing an increase in volatility generally. You can actually see that through here. Volume probably above average on those two as well. And I'm looking here and here for some of those indications. So that was where I went to 67. I haven't gone to the next level yet, and I did say I'd close beneath that level I would, and we have actually closed there. So happy to start moving towards the next level down, which it would be 50%, and then the final level is 33%. So people, hey Carl, why don't you just go all cash? I don't like to go all cash. I've entertained that notion in the past, but I just think it's a bit foolish to think that you should be all cash, because there's always going to be uptrends. There's always going to be strong uptrends, even in the worst market, because there are still companies that are shooting lights out, and they deserve some upside risk. That's the first thing. Second thing is that 33% still encompasses short trades as well. You might say, hey Carl, why don't you just go all short? Why don't you just go, your model's turned down. Congratulations, it's a very good model and it seems to be working quite well. Why don't you just go short now? And there's some reasons for that as well. I don't like to have all shorts, because I've learnt through many bear markets, not just the last one, but the one and the one before that bear markets are volatile, and you can do the research. The research will show bear markets are more volatile than bull markets, and that's just logic. So it makes sense to actually have less risk in the market during those very, very volatile periods. So it's still ability to take some shorts, still ability to take some longs, but overall, the vast majority of your capital is safe in cash, earning 4% if you can get it around the place, or you could go to bonds, but that's not a capital stable product. So hopefully that just sheds some light on some of the queries I've had. I'm happy to move towards a half full bucket here on the Nasdaq. Moving to the ASX 200 now. And we can see we're far more progressed, and on that day I flagged moving to the 2/3. On this day here I flagged moving to the half, and on that day there, but probably should have done it on that day, moved to the lowest risk setting. So lowest risk setting here on the ASX 200, which in advance managed to avoid those falls yesterday. A hooly-dooly for me. I didn't predict it. It's just following a model. So it is following a model that is simply telling us how that relationship between demand and supply is changing, and that's all my analysis, ladies and gentlemen. That's the secret of my success. I don't worry about fancy indicators and squiggly lines. I don't worry about what the experts are saying about the economy or different stocks. I simply look to the underlying demand supply fundamentals, because these are the basic tenets of economics, and they're reliable. Demand side market, equilibrium market, clear as day, supply side market, and that's all we need to know. I'm happy to be at 1/3 risk on the ASX 200, and hopefully that discussion sheds some light on some of the vagaries of my risk management model, but I think it's pretty simple. Graham's got for us today a question about NXG, and we're going to start here and then I'll get to your requests. Let's go back to here, because up to this point, we're risk on, aren't we? We're full bucket on this particular stock, and you can use the same sort of thinking, because a lot of people view stocks as where am I going to buy, and normally I buy $5,000, or I buy 1,000 shares or whatever they might be, and they buy their $5,000, and then it becomes a question of, well, where am I going to sell? And they sell their $5,000, and I think that's a really inefficient way of doing things, because if you're going to be all in and all out, let's call it, then it puts a lot of pressure on those two decisions. I prefer to simply plus R, isn't it? You've heard this concept before. So this idea of I'm going to add risk on this particular trade because it seems to be showing signs of demand side control. And I know when I've got demand side control, more often than not, the price tends to go up. So you would have seen me in my ChartWatch ASX scans. No doubt on that time, I'm sure on that day I put a plus R on it. And then certainly on this day, and I can read these off because I just know the candles, and people have been listening to me long enough know, yep, that's one of Carl's plus R's. So is that. So let's use the $5,000 example. Maybe you're divvying it into 5 amounts. So each plus R equals 1,000, or maybe it's 2 amounts, or maybe it's the 3 amounts. I'm not here to tell you what to do in that regard, but just conceptually moving money in as the trend is telling you that there's more and more control in the market. And then it's a matter of the same way. We're taking pressure off, well, I have to get all out, I have to get the high. That's a pretty interesting candle right there. That is a gap. And what we really should be, the way we really should be thinking about this candle here is that we need to join the dots here and say that, well, if we look at where that closed the day before and then where it started well below its closing price, and that's still part of supply. because the gaps can be really deceptive. As you look at a gap, you think that's a window. Some people call them. There's a space there. There's a void, and therefore that void is meaningless. That void means more than anything. The price adjusted so quickly that there was nobody in between to demand. There was nobody in that, let's just use round numbers, $14.50 to $14 band of price that said, you know what, this is worth buying. So where the supply started us the next day and demand started us the next day was significantly lower. It's a big shift in market thinking. And then, of course, rather than buy the dip, and this is what the black candle tells us, its closing was beneath its open, rather than buy the dip, the supply continued to overwhelm demand. Demand got pretty much out of the way. We can tell from volume, and price action is one thing. Volume often tells us how much is happening. Substantially above average volume. I'm going to say about 4 times just by eyeballing it here. And if you're wondering what I'm looking at, that's the volume indicator here, and we've just got a very long-term moving average operating over the individual volume bars, and that way visually I can see in an instant whether we're above average or below average volume. And that's telling me, is there something interesting going on, or is there something not interesting going on? And we've got the optimized true range here. Now you can use ATR, use a 1 period ATR, you're going to get very much a similar result, but the ATR does treat gaps a bit differently to my optimized true range. That's why I created the optimized true range, because I optimized the ATR. You can't get that anywhere else. It's one of mine, but the ATR 1 period is a simple proxy, and then run a moving average over it. You can look at the charts like mine. Again, is something interesting going on? That's what that's telling me, and the price action is telling me, confirming that something interesting is going on. Who's got control? So a candle like that, there's no reason why a candle like that can't be your first indication to minus R. Carl, but the fundamentals are still really good. Nexgen Energy, they've got a big project over there in Canada. They're going to be producing a lot of uranium in the next few years. Why would I want to minus R at that stage? I say, you can do it if you want. I don't care. This is my model. When I see a supply side showing of significance, which is this, and I want this to be as objective as possible. There's a little bit of subjectivity. Is that a big candle? Is there a gap? Do I need to fill it in? But I think there's a lot of objectivity as well. Is that we know that's a big candle. I've taught you how to do that. We know it's above average in terms of volume of volatility. We know something interesting is going on, so therefore we need to take note. Now we're moving into lower peaks and lower troughs. So again, we're applying pretty straightforward rules here. We've also had some interaction with the short-term downtrend ribbon. We've closed beneath it. So for me, I think we've got another couple of reasons. So you can stack these minus R's as well. So we're going to stack 2 on this day here because we've got 2 things happening. In fact, you could almost go 3 because that gap as well is so substantial that it deserves another R. So we're going 1 R for the big gap, big supply side showing. We could talk about volume. Actually, volume's average there, but certainly volatility, that's the key. Close beneath the short-term trend ribbon and moving now into lower peaks and lower troughs. Now, I don't know how many bits that you're divvying your risk into, but it's pretty unlikely we're going to have a full risk position there. On that day, we might be thinking, okay, we've probably made a mistake. You could even choose to add risk on that day. That's up to you. It goes up, but I think we're going to find pretty soon, even if you added a bit of risk back in, we're still finding these minus R signals. And I'll put a plus R there just for argument's sake, and say that even if you added some risk back in there, then we're still going to find, we know the future, don't we? Several potential minus R events, we call them, through here. So just using it as a case study, and I'm sure this is probably going to resonate with you, considering how maybe you managed your risk over some of the other trades that you've got going at this point in time, or how you didn't. But I think it's pretty clear here that you wouldn't have a full risk position, or FRP as we often call it. You'd be less than that. For me, given where it is, I'm going to go a ZRP, as I call it. So ZRP means zero risk position, which means I can't see any reason to have any risk on Nexgen Energy at this time. But that may change, and it won't change by accident. It'll change by it doing all the things that I want to see it do. Rising peaks and rising troughs, predominance of white candles, strong, demand side showings, even on volume here. Because the problem now is that we've got a bunch of latent supply up here. Because undoubtedly we've got a bunch of people that were probably adding risk around this level. And how are they feeling now? We all know this feeling of really realising we've made a mistake and wanting to get out. But I can tell you the people who got in at 15, they don't want to get out at 12. They want to get out at 15 or at least 13, 14, as close to their break-even point as possible wherever they got in. So we find that once we create these points of supply, I call them, that we are very likely to see interactions. And how will you know? How will you know that supply is actually manifesting in the system? You'll see it in black candles. You'll see it in lower peaks and things like that. So that's a pass for me right now. Steve's got in there first his suggestion for GNP. And if you want the trend ribbons, I can certainly get them to you. If you have a TradingView account, you only need the free or basic subscription. And I'll tell you how to do that towards the end of today's presentation. Steve saying, interested in what are actions. Good, I'm glad Steve's talking in terms of R, because really at the end of the day, with any opportunity we have three options: plus R, equals R, which is just hold the risk I have if I have it, or minus R. Let's do the price action. So trends are pretty clear here, Steve. It's just a checklist, isn't it? And you've seen me do this so many times in my articles on ChartWatch, where literally I go through checklists, and that's all my model is, a series of checklists. So we start with trends first. We're going to start with the short-term trend and the long-term trend. Then we'll go to price action. Okay, then we'll go to candles, and then we'll see if we've got any signals in the let's just go volume and volatility here, because they're both VOLs, aren't they? The two vols. Starting with trends, short-term trend is neutral at best. At worst, it's down, and the reason for that is we've got lower peaks and lower troughs in the price action. We've got a close beneath the short-term trend ribbon. So these are all absolute checklist items or sub-checklist items for the short-term trend. So if we draw an arrow out here, we're looking at actually the price action will help determine. So the price action, we're looking at the close above or below the ribbon, and we're looking for dynamic D or S. So these are some of the factors I'm looking for here. So price action down, there's a pretty good indication that the short-term trend has changed. Close beneath the trend ribbon, pretty good indication that the short-term trend has changed. Short-term trend ribbon beginning to act as a zone of dynamic supply. What does that mean? Well, on the way up, you can see here like clockwork, absolute clockwork, and I think there are hundreds of people that have requested my ribbons now that I've given them access to, which just makes me feel wonderful that people are using this now every day. But the feedback is overwhelming, because when you see this for the first time, you kind of can't believe it. On the way up, the short-term trend ribbon tends to support price until it doesn't, because when we start to close beneath it, it tends to oppose the price, or it tends to impede the price going back up. And that upward pointing shadow, though, is really the first evidence of that. Now, it's just one candle at this stage, but we do have some evidence in play. And what's happening in this candle with that shadow is the price was moving up towards there, and that shadow indicates an area in price where it couldn't stay. It couldn't hold on to that level. The way candlesticks are formed, of course, because it's a white candle, the open is down here, the close is here, and it was up here at one stage. The high is up here. Okay, so it was beaten down from the trend ribbon. So for me, it's pretty clear that we are in a short-term downtrend, and that has ramifications in itself for potential risk. And straight away, if I'm thinking, well, for a short-term downtrend, there's no way I could possibly warrant a full risk position on this. So straight away, I can go, well, minus R. Okay, how much? That's beyond the scope of what I can talk to you about today. I can only just teach you my model, and then hope that you have learned enough to apply it yourself. Close beneath the ribbon. Ribbon has transitioned to neutral. That's a pretty good giveaway as well. Starting to fall. Dynamic supply. Any more than that, obviously the price action's heading down. So look, I think there's a couple of R's here, really. So order of magnitude. Remember, they stack. So a couple of R's there. Does that mean we're all out of Genusplus Group? I don't think so. I mean, this is still pretty healthy, and it's a progression. I'd be looking at this candle's low here. Okay, it's a point where we saw a decent amount of demand come in, and by decent, I can start to look downstairs here and see that there's significant volatility in that day. We saw an early sell-off. At one stage, ladies and gentlemen, make no mistake, that candle was full and black. What stopped it from being full and black is that the demand started to come in on that day. and push the price back up. And supply didn't have an answer until we got to a point where supply said stop. That's all you're getting today. So we do know that there is latent demand in the system down here. Okay. Now, if we were to close beneath the low of that candle, what's happened to that demand? Is it still working away in the system, or has it been consumed by the supply side? So demand is cash. Demand is cash looking to buy, looking to allocate risk to the market for whatever reason. I would suggest to you that the people who are buying in there, the fund managers that are buying there, they've done their research. They like the stock. But there's also sellers. There's also fund managers that bought it at $3 and now think it's overvalued. And these candles, this price action, these trends, all they're telling us is the battle between the fund managers that love the stock, fund managers that don't like the stock anymore. So if we were to close beneath that downward pointing shadow, it would suggest to me that the demand that was there, the very promising demand that's really trying to perpetuate this uptrend, has been consumed. That cash has got shares. If that cash has got shares and the supply side is still strong enough to keep the price going down, then we've got a lot of cash, because I know there's a lot of cash went in. I can see from the volume, more than double. That a lot of cash now is sitting in here wishing they weren't in there. And that's why often we say that previous points of demand start to act as future points of supply. So look, I think that's enough analysis on that one, Steve, to say, there's clearly some indications there that a full risk position, in my view, is not entirely appropriate, but there's also still some indications that demand side is still working the system. Even today's candle, that's the last candle there, is showing the same sign. So again, you think I make this stuff up, to sound good. We're even in today's candle, you can just see that the demand is working into the system. Now, today's candle's not closed. So yes, the demand's working into the system. It's producing this white candle downward pointing shadow today, but we need to see how the supply side responds to that, or if they do. Okay. I think that's a super interesting case study, but I'm a little bit biased. I think I'm probably going to find they're all super interesting case studies. Let's keep going. Hari's got, can you tell me how to identify latent supply? Well, I think that's, we've touched on that already, Hari, in many ways, that latent supply is going to occur around previous points of supply. So there's a point of supply up there. Hey, Carl, how do you know that's a point of supply? Well, the price came down. Again, we talk about these most basic fundamental tenets of economics. Did the price go down? There's only one reason for that. Because the fundamentals are bad, the news is bad, there was an expert that came out and said that it's not good anymore. No. All of those things are superfluous. The news, the fundamentals, what the experts think. Because at the end of the day, all of those three things become either demand or supply. So we're bypassing that. This is an incredible circuit breaker here, analysing the markets in this way by saying, you know what? It went down, so there was excess supply. Why was there excess supply? I don't care and I don't know. I don't know and I don't care, but it's there, and I need to monitor that now, okay? As we start to push into that latent supply, we're going to see how demand supply manifests in the candles. So if we start to see white candles, high volume, it's telling us that we are interacting with that supply. The only way to clean out that supply, Hari, is to trade with them. That supply is sitting there. They are shares that want to be out of the market. Why do they want to be out of the market? I've explained this. There's two components here. People who got in at the high regret being out of the high. That's latent supply. The other half of it is people who didn't get out at the high. They were in. They've been in from $3. They didn't get out at $7. You know the feeling. You've been holding this all the way up. You're going, geez, isn't my GNP good? Geez, isn't my GNP good? Oh, why didn't I get out at the high? I knew $7 was going to be the top. I knew I should have sold on that day. I was up this amount of dollars and cents. I know exactly how much my profit was. And I knew I should have been out. Should I get out now? No, I can't get out now because it's not the top. See, I deserve the top. I better get the top or else. So this is the way people think. They will hold on now. If it's $6, they will hold on until they get $7 and then sell at $7 where they should have sold last time. So they can, I got the top. Aren't I clever? So for that $1 upside, they'll never sell again, right? I mean, it'll go to $5. Nope, still want $7. I deserve $7. $4, got to get $7. $3, $2. No, this one's in the bottom drawer now. Yeah, no, it's a bottom drawer. It'll come good eventually. I'll get my $7, don't you worry. So to get that $1 of upside, they're going to risk $6 worth of downside. I'm not saying that's you, but I'm saying somebody else has probably thought like that. But Hardie, this is the point. Excess latent supply, I should say, comes from people who didn't get out or did get in at the end of the day. And the candles will tell us we need to trade with them now. White candles, high volume tells us we're trading with them. White candles tells us the demand side is coming back into control. If we get into that area and we see black candles, upward pointing shadows, it's saying no, supply is still strong and the demand that's coming in is just being overwhelmed. Okay. Now, I'm not going to do it now, but I want you to think about this, and even if we don't do it today because we don't get the case study for it, latent demand is just the opposite of all those things. It's just turn it on its head. And you've got a model for tops and bottoms. Let's go to Ryan is saying, hi Carl, would like your thoughts on Orica. Let's head there next. And I must remember, of course, to do the zoom normal. So we're looking at our each new chart on a consistent basis. Yes, you can zoom in, get the finer details, draw all the peaks and troughs, all the lines you want to do, the minus R's on the screen. But when you go to the next one, make sure you start at that zoom. So we're seeing our trends on a like-for-like basis. So, if we're comparing between two trends, well, is this one better or is this one better? It should become really clear straight away. Now, isn't this an amazing just picture of excess demand? I know there's a couple of candles at the end there that aren't looking ideal, but I think that tells the story down here. The relative strength comparatives, not the relative strength index, the RSI, relative strength index. I'm pretty sure that's another Wells Wilder indicator, which tells you roughly where the price is within a range. It does some standardising and a few whiz-bang stuff in the maths, which for me is quite useless. I've actually done studies of backtests to determine that the RSI is really hardly worth using. But the RSC is worth using, in my opinion, because it tells us, is the stock beating the index within each sits? And look, I don't make this one public yet. Maybe that'll change in the future, but I've got to keep a couple of things up my sleeve. But the RSC you get on TradingView or some of the other platforms, look, it's going to do much of the same work here. It just probably won't give you that clean moving above and below zero, maybe that my one does. But if it's heading up, it's beating the market. So what we're seeing here is that, and this is going to become more relevant now than many other times, ladies and gentlemen, because we know the market's coming off. We saw the ASX 200 peeling away. And we know that en masse stocks tend to be going down, but yet this one's still going up. What does that tell you about the way the fund managers are thinking? Now, most of the big stocks, ASX 200 stocks, they're going to be bought and sold based upon what the index is doing, because you've got a lot of passive funds that simply try and track the index. So if the index is going up, they have to buy. If the index is going down, they have to sell. It's not their fault. That's just what they're mandated to do. And you give them your money to do something, as I don't know, as basic. I was going to use some other words there, as basic as that. Okay, they're not going, risk bucket sort of stuff. They're just following the market. Passive money, dumb money, whatever you want to call it. So this is not, I guess, well, it's still going to be sold off. It's still going to be sold off by the dumb money, but it's not going down. So what is that telling you about what the smart money's doing? And I think that's the critical message here. Stocks that continue to go up even when the market's going down, then yes, they're being sold by the dumb money, but they must be being bought by the smart money. Now, how long that lasts, because eventually, if the market gets so bad, not even Orica is going to, some of the smart money is going to start to get out anyway, because they're probably going to try and cover their losses. And this is the key, isn't it? When you think about it, we know that the stocks are the best even in the downtrend, but even if the market gets so bad, we know that some of those fund managers, because they're losing money hand over fist somewhere else, they're going to start to look at their best ones to take profits there to pay for some of those losses that when it comes reporting time, this can still get their bonus. But for now, I know I've gone way off topic there. Let's do the checklist, because that's all we have to do at any time, ladies and gentlemen. Please, just if you're unsure, what should I do? Go to the checklist, do the checklist. Analyse the 3 A's, as I've coined them. I literally coined them a day ago and said 3 A's, analyse, accept the result of the analysis. Okay, that's so crucial, because we can do the analysis and say, I need to minus R and then not do it, isn't it? Or I need to plus R and not do it. Analyse, that's your checklist. Accept, okay, and the accept is based upon MOTN, more often than not, okay? So we do the analysis, and we determine a more often than not outcome, and then accept that, and then action it. Take some action. Manage your risk. So let's do the analysis. Short-term trend is still up. I know there's a couple of candles. We'll get to those. Long-term trend is still up. The demand side is in control. Traders like this. Long-term investors like this. Relative strength is off the charts. The price action is still rising peaks and rising troughs. Yes, actually, we're not even coming down. We're not even coming down this way because the way we draw the downs, okay, the way we draw the downs is a lower high and a lower low on a day. Oh, let's go candle to candle basis, right? It's that simple. It's black and white. You cannot stuff this up. As much as I know you'll try, you cannot blow this. If there's a lower high and a lower low, you start to draw a line down. Now, you don't know how long that line's going to be because we can't see what's going to happen next, but you can start to draw the line down. The up segment is just the opposite. It's going to be a higher high and a higher low. So we've still actually got higher highs and higher lows as the most recent scenario. I know this is higher high and lower low, isn't it? So this is something different, high high and high low, but it hasn't given us a reason through a lower high and a lower low to draw the line down the other side, and we just wait until we get that reason. So outside candles, inside candles, they don't mean anything. You might say, Carl, you get a really big outside candle. When does that mean something? And it does, and I have some rules for that, and I'll leave that as something we might do down the track. I've got to keep some stuff so that you keep coming back next week and next week, ladies and gentlemen. I'll give it all to you today, you won't come back next week. So we could say that in terms of our short-term trend, ribbon is green. It's heading up. The price action is rising peaks and rising troughs. The price is above the short-term trend ribbon. The short-term trend ribbon, as far as we can tell, still appears to be offering dynamic demand, or it seems to be acting as a zone of dynamic demand. So tick, 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 short-term trend is up. Long-term trend, well, that's easy. Price action we know is good. We've got big moves on the motive faces. We've got shallow moves on the pullback faces. Tick, tick, tick. Predominance of demand side candles. I know, yes, I know. I'm getting to that one. But this is still demand side. I know that one's a bit indeterminate. Okay, but otherwise, still a predominance of demand side candles. And I usually go back about a month. How long's a month? It's about 21 candles. Now, let's get to the candle. I know you're all going, Carl, minus R the hell out of that thing, buddy. It's going down, mate. Just trust me on this. That's a minus R. And I would say, I don't think so. I don't agree with you, and I get it. It's easy when we're in the heat of the moment and the rest of the market is crashing down around us, and this is our last stock showing any profit, to see that one candle go, bang, minus R, I'm out of there. But that candle is small, isn't it, within the context of those last 21 candles, the last month or so. It has very little progress to the downside. It's actually got a little downward pointing shadow as well. We're nowhere near the short-term trend ribbon. We're not interacting with it. I mean, I think if you go to minus R on that one, I think you're jumping at shadows a little bit. But certainly it's a supply side showing. So what does that mean? What's the action? The action is to monitor this now. Okay, if Orica's in our portfolio, I mean, don't forget our job is to check our portfolio in line with our periodicity. Our periodicity, if we've had this discussion so many times, go back into the old videos, but is daily, weekly, monthly. Okay, and if we've committed to checking this on a daily chart, I know we don't look at weekly charts here, but some people will look at weekly charts exclusively, right? We're daily charts here, just accept it. That's the way we're doing things in the webinars. But if we are at daily periodicity, I have to check it tomorrow. So I have to do it anyway, but I'm 100% not going to miss tomorrow in Orica, am I? Because I know I need to look for confirmation of excess supply. Is the supply that's starting to creep in building, or does the demand side still have them in check? And I don't know the answer to that question, ladies and gentlemen. Yeah, this is where I'm driving by looking in the rearview mirror. I won't see the supply till it's there. And it could be a big black candle, and I'll go, oh, no, I should have minused R yesterday. I can guarantee I won't think like that, ladies and gentlemen, because I did my analysis, I accepted it, and I made my decision. I did my action. My action was to do nothing, and doing nothing is an action, ladies and gentlemen. Okay, because to do something here and see a big white candle the next day, you haven't followed the trend. You haven't been true to the underlying demand-supply fundamentals. The more often than not, I think it's still this one heading up. That's my opinion. So we haven't done this today. This is a nice one. Equals R. I'm still equals R on this. I could even go plus R, and I'll just put it up here because probably it's going to happen up there. We're going to need to see another demand side candle. What does a demand side candle look like? Well, it looks like that. That's not that one there. That one there, oh, look, a little bit of upper shadow, but I still think it's good. That's still very strong. That's very strong. Even that one's still very strong. That's very strong. But even these ones. So any sort of demand side candle heading back up, because everything is still so fresh and so good. I could even add R. But you'll see me qualify that plus R with on the next demand side candle. Okay. So right now I'm at equals R, but I could plus R on the next demand side candle. Then the question becomes, okay, well, where do we minus R? And it's still really too early to tell, but we've talked about some of the things that I would need to see. So lower peaks and lower troughs, big red flag. Big black candles, big red flag. Big black candles on above average volume and volatility, big red flag. Okay, closing beneath the short-term trend ribbon, big red flag. And here's the thing, ladies and gentlemen. Oh, Carl, by then, ... And we all know by then it's going to be lower in price. We know that. But this is the leap of faith we must take as trend followers to try and get more and get more and get more. Okay, because you just need just a few of those really fantastic trends, and to be adding risk throughout those trends, it'll pay off your whole year. Well, I think we're getting some great case studies here. OSM, you've got three options here, right? Demand side control, equilibrium, or supply side control. Supply side control, question mark. What are we in here? And straight away, to your now trained eyes, you should be able to make a call on something that broad and that simple. Look, I think that's demand side control. I think we're kind of, I think we're, look, I don't even think we're even kind of there. I know the short-term trend is kind of trundling up the screen. I know the long-term trend still looks very good, but I think this is more of an equilibrium phase, and we don't know which way it's going to go. It could move back to demand, could move there. I mean, there's three options, isn't it? Do I need to spend any more time looking at Osmond Resources? Now, if I've got it, I'm committed to checking it every day and doing my plus R equals R minus R analysis. But if I don't have it, would I spend much time looking at this? And I don't think so. I don't think I need to. I'm going to move on to the next one. But that doesn't mean that in my scans, I'm going to be scanning through many stocks each day. And if it starts to print the white candles, the high peaks and high troughs, then I'll start to look at it then. And I'll only need to look at it then. Okay, I could get to equals R on this because the short-term trend is, if I squint up, long-term trend is definitely up. The price action isn't terrible, the candles aren't terrible either, but I'm certainly not adding risk. I could add risk though. I could add some risk. If I see a nice demand side candle up here, where would I start to reduce risk? Look, I think it's all the way down here, isn't it? That we're going to certainly see minus R's down here. Lower peaks and lower troughs first could get us a minus R. Big black candles on volume, things like that. But yeah, it's a bit of a pass for me at the moment. Let's keep moving. Who was that one? That was Gavin. Domino's Pizza, super interesting. I'm glad, Peter, you've asked about this one today. We talked about the potential here in previous weeks for the long-term trend ribbon to come in and do some damage to this Domino's Pizza rally. Fledgling rally, promising rally. Hey, I hope it gets up. So don't think because I've put Domino's Pizza in my downtrends lists about, 50 times, 50 times between, I don't know how long it's been going since, well, it's been going since here, hasn't it? ChartWatch ASX scans. So between there and down here, it's almost a daily appearance for Domino's. I've recently started to put it in the uptrends list. Oh, Carl, it's not in an uptrend list. It's not in an uptrend yet. Why are you doing that? Because we've got different types of setups. So we've seen a lot of continuation setups, but I also have a turnaround setup because stocks aren't always just going bottom left, top right. Sometimes they're turning around. And then I've also got an aggressive setup, which we haven't talked about much in these sessions yet, but we may get to them soon. This one is more of a turnaround. So turnaround is we're interacting with the long-term trend ribbon. We're trying to turn its trend. I mean, that's the turn that we're talking about, is the turn of the long-term trend, isn't it? Because the short-term trend's already turned. So for it to be a turnaround setup, right, I need to see a short-term uptrend. I must see it. Okay, I cannot trade a turnaround setup that is a long-term trend is turning up without seeing a short-term uptrend. I have to have a tick. So that's going to keep me out of a lot of junk. I can't buy Domino's here. 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 I could contemplate it here. Okay, but clearly we didn't get any price action. Did I have rising peaks and rising troughs? Because that's another condition. No, I didn't. Did I have a predominance of demand side candles? No, I didn't. Okay, could I have bought it here? Well, we didn't get. I like to say you need to get at least into the top half of the trend ribbon, at least the top half, because there's less of it above you than there is beneath you. We didn't get there, so that one's not even coming in question. So short-term uptrend, rising peaks and rising troughs. Let's cover those off. And I know I'm not checking every high and every low, ladies and gentlemen, so I'm trying to do this quickly, but that's pretty close, I reckon. So yes, nice extension on the motive phases, shallow pullbacks. Looks pretty good to me. Predominance of white candles, yes, we do. I know we've got that black one there yesterday. Okay, are we in the top half of the trend ribbon? Yes, we are. In fact, we poked and closed above it. That's really good. Are we seeing the long-term trend ribbon act as a zone of dynamic demand? That's the final factor. Is the trend ribbon now an area where the price is trying to bounce above or bounce in? If it's in it, bouncing out of it. Did we see that before? No. So this is actually really good confirmation here that the turnaround setups are risky. They're riskier, in my opinion, than the continuation setups because the supply side is still clearly, lurking in the market around that long-term trend ribbon. And therefore, we need to understand that they could come back in at any time. The market's not convinced yet. Hey, when we're double greens, the market's convinced, but here not. So higher risk, certainly consider that. So this one actually was a bit more of an aggressive setup because we haven't seen the point of demand forward in or above. It was very close. Massively strong candle. I'm pretty sure that's the first day. So this is actually more of an aggressive setup because I didn't have that final thing. An aggressive setup is similar criteria, okay, but it can occur beneath here if we have at least one-to-one reward to risk. This is the first point for me that I can even contemplate adding risk, and that might seem absolutely crazy to some people because it's above $20 and it was 13. Why didn't you just buy it at 13, mate? I mean, come on, it was cheap down there. There was somebody I saw at online or on a particular show or at a particular conference told me that it was the best thing to buy since pizza. Look at the long-term trend, look at the short-term trend, look at the price action. At that point, supply was overwhelming and the supply had done all the research and they didn't like the stock, and demand, they weren't getting in the way. But anything can happen in markets. And guess what happened here? Well, all of a sudden we're getting talk about private equity coming in to take it over. And things can change. The shorts, and to make no mistake, the shorts were short to their back teeth on this thing. And doing very well, mind you. And you might say, the shorts are getting crucified here. The shorts are fine. The shorts shorted it at $100. So the shorts don't really care if they cover it back at 12, 13, 14, or 15. Don't worry about the shorts. They're just fine, okay? But they also probably don't care, and they're just getting out now. They've made so much money on this. But don't forget that short covering is demand as well. And then we've got the speculative buy, the private equity story. And without the shorts, this is the other thing, the shorts want easy prey. They don't want a private equity story. They don't want to muck around with that. So they'll go off and find something nice and easy to short. And there's plenty of opportunities right now in the market, let me assure you. So they'll just get the hell out. But take the shorts out of the equation now. No new shorts are coming in because they're looking for easier pickings. Without that supply from the new shorts and with a bit of extra demand in the system, guess what happens, ladies and gentlemen? Right? Price action turns. Trend ribbons change. Candles start to be wide. Now, how long is it going to go? I don't know. But long story short, plus for me here, I'm on record. It'll go as long as it goes. Is that a minus R date? I don't think so. I think it's pretty small. It's pretty minor. Let's see how we got the long-term trend ribbon, because what I want to see now is this long-term trend ribbon really stamping its authority. And then who knows where we could go. Okay, so that's where I'm at on today's candle officially. I would still be equals R. On the next demand side candle, I could go plus R. Next demand side candle. Minus R, you know what would need to happen. Lower peaks, lower troughs, big black candles, volume, all that sort of stuff. So again, another really interesting case study there. I would coin this one an aggressive turnaround setup. Okay. But again, don't get too caught up on some of these names, these naming conventions for the setups, because everything needs to come back to demand and supply. And hopefully you can see that I'm not just doing this on a whim. I'm not just going, I think Domino's is cheap and buying it. It's just, that could not be furthest away from my methodology. Droneshield, we covered this one last week, so I don't think I've got a lot to add actually. So Kyle, go back to last week's video, and it's really easy. Each video I produce has the timestamps. And look at Droneshield, and we came up with the conclusion of ZRP at that stage. But we also did it as a case study, and there's no point in me going over this case study again, where we had just so many reasons to minus R like crazy. And even after today's discussion, you can see how many times you would have minused R. There's absolutely no way, even by last week, using my model, that you could have had any risk on Droneshield, and nor would you have it now. I don't need to spend any time talking about it now because it's not going to meet any of my criteria. The price action is down, the short-term trend is down, and it's beneath the long-term trend ribbon. And lo and behold, the long-term trend ribbon is now acting as a zone of dynamic supply as well. We can see here the formation of today's peak, and today's still trading, so we'll get confirmation of that by the close. Let me just reiterate ZRP on that one. Oh, but Carl, Droneshield, let me tell you about Droneshield. Oh, I'm sorry, honestly, I couldn't care less, because there's nothing you could tell me that isn't in demand and supply. So why would I bother listening? ZRP on that one. Oh, but Carl, it's going to be like Domino's. Buy it now at $2, and in 3 weeks' time, mate, it's $4 guaranteed. Maybe. I don't know. I just know that picture there, that demand-supply picture, I associate with more often than not going down. That's my gig. If I see one that's more often than not going up, based upon model, I'm happy to entertain it. Qantas for a short, Ryan, good. Oh, somebody talking about shorts now. I think this is now under a lot of pressure. I can't tell you to buy, hold, sell, or long or short. That's beyond the remit here. But I can certainly point out, based upon my checklist, that I believe that the supply side is in control of the price now, because we're in a short-term downtrend. Okay, we've got falling peaks and falling troughs. I would argue predominance of supply side candles, although it's not as bad as many of the ones I've seen. So there are probably better ones than this, Ryan, out there, simply on that basis. But the next strong supply side candle, this is as far as my remit goes, I personally would be minusing R on the next supply side candle. Next supply side candle. Okay. In addition to that, there's no way my model could have any risk on Qantas at this stage. It's a ZRP for me. Okay, so it's not an equals R. You've seen me say equals R. I'm happy to hold it if I had it. But no, this is ZRP. I cannot own Qantas. In terms of case study stuff, going back and saying, oh, well, that's where we would have done it. And I know it feels like, oh, he's Harry Hindsight, but hopefully you agree now that the model it's clear cut. It's black and white, because the candles are black and white. And just in your brain, call out minus R. You don't have to call out because I can't hear you, but in your brain, call out minus R. This upper shadow here, in combination with that, closing proximity to the short-term trend ribbon, I'm going to say, if you minus R on that day, I wouldn't complain. Where's the next minus R? Call it out. You don't have to tell me. There's a reason why I'm pausing there. I think by now, it's pretty obvious, isn't it? The short-term trends, there's a few things that have happened there. Okay, super quick lithium. That is now a long-term uptrend. That is now continuation stuff on Australian spodumene, because we've actually got a dark green ribbon there. And it never happened before, because I only started charting this one back in December 2023. So the long-term trend ribbon has never been up. So that's unprecedented there now. I know there's probably data before that, but that's pretty interesting. And then heading over to the lithium carbonate here, we have got a classic turnaround set up as well, where the price action is now treating that long-term trend ribbon as a zone of dynamic demand. We've got rising peaks and rising troughs. We've got predominance of white candles and some massive candles there on some massive volume. So you see a big white candle, ladies and gentlemen. That means you've got incredibly motivated demand. Let's go check out the volume, because maybe there's something else going on. So there's actually massive volume. It's almost record volume there. So it wasn't a matter of the supply getting out of the way now. We've got extremely motivated demand. That's the same. But supply was motivated too. Think about that. Huge volume says that supply was really motivated. Well, that can't be good. Wait a second. That's not good. Supply really wanted to get the hell out of that day. Yes. but demand wanted to get in more. And what we've done now is we've removed a huge amount of supply. They are pivotal. They are critical days. Big candles. And this is why I say big candles, volume, watch out, right? Because we have taken a huge amount of supply out of the market there. Okay, you say, okay, wait a second, Carl. Supply isn't gone. It's gone into demand. Demand's now got it. Yes, but that supply at that level is gone. So the demand side, they're getting it at 90, right? The supply that thought 95 was the cap or 90 was the cap, they're gone. That's the way I should phrase this. What we've done is removed the supply who thought 90 to 95 was as high as this thing could go. Why was that as high as they could go? That's why they sold there. They didn't sell there by accident. They sold there because that's as high as they thought it would go. But we're replacing them by holders or new supply that is not thinking 90 to 95 is the place they want to get out. Where do they want to get out? If you buy it at 90 to 95, you want to get out at 200, right? You want to get out at 300. You want to get out at 400. So what we're doing here is we're removing supply that had a very low opinion of price, and we're replacing it with potential, with latent supply, this is the key, who has a very high opinion of price. Okay, so they're going to potentially withhold their supply until 200, whatever. So massively important candle there, and we've seen a few of them. Hopefully that made sense to you. If it didn't, we'll touch upon those things before, this interaction between volume and price action, because it is absolutely pivotal. Just quickly from the top to the bottom, double greens, happy to continue to be equals risk and plus R on the next demand side candle. In fact, all I need to do really is probably copy and paste some of these things from last week, okay? And if I see something sinister in any of these, I will absolutely let you know. Certainly not as strong as the last one we saw, but not a reason at this stage to not be equals R. I still think it's fine, but in terms of relative strength, not as good as Pilbara Minerals. LTR still looks strong. I know today's down, but nothing goes up in a straight line. Even if we saw a bit of a pullback here, it wouldn't be much of a surprise, but otherwise still strong enough to warrant equals R. IGO, this one's actually a little bit more concerning to me. So if today's candle closes the way it is looking, or worse, then the combination of those two candles otherwise, and it's just a minus R, it's not throw the baby out with the bathwater. And I'm only going to do a few more. CXO, a much weaker signal from the supply side, so still equals R for me. ELV, I'm going to put that, if it closes as it's looking today or worse, then I would put that in the IGO camp. And then we'll go VUL, which is that one there. This one never got going. I don't think I've put this in as a plus R very, very recently. So yeah, you can see today's candle is a little bit questionable on that one. And if it closes there or worse, for me, that would be a minus R event. And I'm trying to remember some of the other ones. Equals R still there for me. Not terrible. Today's lower shadow is encouraging. GLN, still an equals R for me. GL1, and hopefully I'm not forgetting your favourite lithium stock here. Assuming today's candle closes the way it is with that downward pointing shadow, still happy to go equals R there. So that's the quick lithium review as promised earlier on. So WTC, this one's coming from Sean. And Sean, again, I'll refer you, again, go back to the old videos. There's so much information in those, and you can just click on the stocks you're interested in, and probably the analysis is going to give you an insight into even what's happening today. But as you can see, Sean, we were ZRP here. You can see minus R's. We did this as a case study. There are just dozens of reasons based upon my model to minus the hell R out of this thing. And in many ways, this has been one of the best shorting opportunities I think my model has identified. And that's all hindsight. What about now? It's still, I could do this very easily because it's still a ZRP for me. Oh, but Carl, look, it's looking good now. It's looking really cheap. It maybe is. I don't know. So I can't talk about if it's cheap or expensive because I don't care. All I care about is what the market thinks, and whether the market thinks it's cheap or expensive. I tell you what, if the market thought this thing was cheap, the chart wouldn't look like that. It's impossible. I don't know what's going to happen next. It could be a big white candle tomorrow. Guess what? The market's telling us it's probably starting to be cheap. Okay, but right now, nobody's thinking that way. I can tell you right now. Oh, Carl, there's a fund manager. He told me to buy it. Okay, he's not buying enough of it. Tell me to buy some more. ZRP for me on that one, unequivocal. I'm happy to continue to minus R on that. CIA is an interesting one. Yeah, look, it certainly started to look very good here and would have been happy to add risk there. And then it just kind of got caught up with the rest of the market. And you can see the relative strength is still half decent. So yes, it's coming down, but it's actually not getting beaten up as much as the market. So it's a tough one. I can't be an FRP here. I've got some risk off the table, but probably just got a little bit in the system. And you can see it closed beneath the short-term trend ribbon. You can see yesterday's candle. You can see lower peaks and lower troughs. It'd be on the lower side of a risk position, so less than half would be my opinion. You can do anything you want, but certainly not FRP there, but also not ZRP. And I know I'm rushing because I'm trying to get as many of these done as possible. James Hardie, could this be the next Domino's? It could be. I don't know the future. Anything can happen. And I think we might have the ability to talk about an aggressive. I was going to say an aggressive setup yet. No, we can't because this is still down. So an aggressive setup, I still need to see green there. So no, it's not an aggressive setup yet. So unfortunately, then for me, it's still in the camp of I'm still definitely a ZRP. As in, personally, me, I can't see a single reason in the world to own that stock. I mean, can you? And I can see some good stuff coming in. Okay. Rising peaks and rising troughs. Yesterday's candle is very encouraging. It's very encouraging. Downward pointing shadow, white body, more than double the usual volume. We're seeing some demand impact the system, and the demand, rather than getting beaten back down like every other time, like here, here demand tried to come into the system. Look what happened. Downward pointing shadow, demand tried to come into the system. Here, we had a white candle at one stage. Demand tried to come into the system. Got beaten back down. Here, demand is coming into the system. And it's interesting. That was above average on that day. That one was below average. Above average. Demand's coming into the system, not getting beaten back down. What does that tell you about the supply side? About the supply side's motivation? Are they as motivated as before? So there's some stuff here. If I had it, and you can see I've already told you there's absolutely no way I could have it, I could get to an R equals R, just on the basis that I want to explore the upside. Okay, not because I think this is the best thing to do with my money, far from that, because I'm ZRP, but I could contemplate an equals R. Okay, but I wouldn't own it anyway. And the last one for today is going to be Woolworths from Deepak, who is, I think we go similar. It's a great little segue because the last time we looked at it, I reckon it had just had that candle there. Maybe it was even before. I don't know which one was a Monday. But we said equals R. Ditto on the last one. And I want to explore. I can see that demand is coming into the system. Okay, yes, it's been awful, but I can see in this candle here, above average volume. The RSC is turning the tide. This candle here is pivotal. It's crucial. It's critical. It's the defining factor of the last couple of months. The demand side came back in. They came back in substantial numbers. I know that because the volume is double the average. And they were met. They were met with supply, but they won the battle. So I could go equals R on that one. This is a super interesting one. I know Hoozle saying, is it a turnaround? No, it's not a turnaround setup yet. And that we can answer unequivocally because it's not interacting with the long-term trend ribbon. It's still got a short-term downtrend. The price action actually has turned up in the candles. That's a very impressive candle, but the candle's still open. It's not closed yet. So it's one of those, I could entertain B equals R. I wouldn't own it, but I could entertain equals R. But no, it's not a turnaround, so I can tell you unequivocally it's not, because it's not meeting the criteria for such. It's not aggressive setup just yet because it's not a green ribbon down here. So hopefully we've done enough, even as I'm doing some of these other ones, to see that it's not hard to answer some of these key questions and fill out these checklists. Right. Interaction there. Here, what do we think about this? It would have been minus R, 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 right? Many, many times. Oh, but Carl, I didn't. What do I do now? Hey, analyse. Does it warrant having risk? Accept that outcome. What is the MOTN of that outcome? And accept it. Action. That's all I can encourage you to do, ladies and gentlemen. If you're listening in the recording and you want to get hold of my trend ribbons, you can do in TradingView. It's the only place I'm offering them at this point in time. You just need to fill out the form that will be in the comments or the description of this video below. Also, if you're listening to the recording, please hit the subscribe button to stay notified of any future updates that I put out to the Market Index YouTube page. Hit the like button, that certainly lets me know that you like what I'm doing, or hit the thumbs down button to tell me that you hate it, or get in the comments and let me know one way or the other. Ladies and gentlemen, it has been an absolute pleasure chatting with you today. Hopefully you learned lots. Hopefully you enjoyed the session. I certainly did. I know markets are under some pressure at the moment, but I think the work we've done today and the work we've been doing over the last few weeks is invaluable in helping average investors. You don't have to be a fund manager to do this stuff. You don't have to be a fund manager to analyse, accept and action. And acceptance is the important one as well. So hopefully that was useful for you today. All the best for your trading and investing until we catch up again. Bye-bye for now.